New year, fresh start. Well, there certainly has been some buzz about how the Fed might begin to lower rates this year. So what does this mean moving forward for fixed income investors and importantly for the economy? Let's find out right now on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore, and I've got my friend Leslie Falconio back in the studio with me to break down the latest out of the fixed income strategist, and importantly, taking a look as we're here in the new year at what's going on in fixed income. So, Leslie, the buzz is that the Fed is going to start lowering rates this year. Certainly, that has been on your horizon from CIO since we've been talking about it last year. But what do you see right now as the path of rates? When will the Fed begin doing this? And could there be any factors maybe out there that would put the Fed at pause or maybe even go the other direction?
Well, I think the Fed is definitely going to be at pause. But to your point, Anthony, you're absolutely right. There is this tug of war between the market and the Fed message. And what I mean by that is if we look at what the market's pricing in, at least around now, is around 115 basis points of easing in 2024. That's fairly aggressive because they have a 47% chance of March, right? 100% chance of May. It's our view that the Fed will ease because our expectations, inflation continues to grind lower, growth continues to grind lower, not negative, but below trend. So at some point we'll have an easier path of policy, but we don't think it's going to be until about May of this year. So, and with the expectation that you're going to get about 75 basis points. So the market is a bit ahead of itself. And here's the thing, when we think about risks, that's probably going to be going on, this tug of war, throughout the entire year, about not necessarily the path of the easing, but when and how much you're going to see this differential between the markets and what the Fed is trying to message.
Yeah, and that's really going to be the thing that I'm sure most investors and analysts are going to be paying close attention to is reading the tea leaves from Jay Powell and the Fed, looking at the minutes from month to month and saying, okay, what's changed? Sometimes it's a word or a comma that indicates where the Fed might be going. But of course, as we've learned, and you and I have talked about a lot of it is kind of the unknown. We're in territory that we really haven't seen before, following a global pandemic, then following significant growth. And last year, equity markets were just on a tear. We saw historic moves in treasury yields. So it kind of gives the whole thing of, look, we're in a new year. Maybe it's a fresh start. Maybe we can kind of clean the slate and start over. But something that you did last year was we looked at higher quality assets. They saw negative growth, that was historic, that we hadn't seen something like 3 consecutive years. So what do you see, panning out this year on the returns for some of those assets that you priced in this last year? What are they expected to do this year?
Well, fortunately, in the end of 2023, most high-quality assets ended in positive territory. Luckily, and that was just because what we saw at the end of the year with yields coming down from that large amount of spike that we saw in October all the way down, right? So it was not by as much of a positive total return that we thought. But with that said, that's what leads us into our outlook this year in 2024, really spending time in that higher quality because of 2 reasons. One, the greater credit embedded sectors had tremendous spread compression. Sure, all risk assets did. All risk assets had a lot of spread compression. And as we head into what we think will be the driver of total return in 24, it's not spread compression. It's going to be yield and carry plus price appreciation, given the fact we think the 10-year yield goes down to about 3.5 at the end of the year. Not in a straight line, but it'll end lower by the end of the year. So these higher quality assets of where we are in the cycle, we think will really be the top performers in 24. Really, probably anywhere from, say, 5 to 8% returns. They have a lot of carry, and they have the potential of that price appreciation because as the economy continues to slow, and as growth slows, you might see these pockets of spread widening in the lower credit quality.
Right.
The higher credit quality, you'll avoid that, and you still have yield, price appreciation, which will really be the drivers.
Well, it kind of begs the question then when we're looking at the year ahead. Now, there's a lot that's happening, right? We've got a lot of geopolitical risk that's continually happening around the world. And on top of that, we've got central banks having to make these really hard decisions, especially here in the U.S. So you and I have spoken about pockets of vulnerability in the markets. Where are those pockets here? When you look at, say, investors in the U.S., should they be concerned about geopolitical risk and also what's happening here with central banks and around the world? What are those pockets that you're talking about?
Yeah, that's a great question. I mean, when we think about the geopolitical risks, more than likely they'll have a greater impact abroad in Europe than they will in the U.S. And one of the reasons why that is that the Fed has done a historical move higher, right? They've gone 525, 550 basis point Fed fund rate in a very short period of time. if those geopolitical risks should ensue, they could ease, right? They could take that, they could try to do that, and the impact to the U.S. is not as great as it would be to other regions abroad in terms of that geopolitical. The risk is that inflation rears its head again. The risk is that also too, outside of the geopolitical or the Fed, either A, higher for longer for too long of a period of time, which skews our soft landing to where it's a harder landing, right? That's not our call, but we don't know really how this is actually going to work out. And having a Fed really maneuver a lower inflation and soft landing with the unemployment rate not going too high or growth not slowing too much would be quite a feat in 2024. So it's one of those things where they either cause a recession by higher for longer, or we have this reinflation somehow. Partly it could be because of that geopolitical risk that causes oil to move up and stay there at, say, at 100 sustainably, or something that causes the Fed to actually hike in 24, which very few people are projecting, particularly not the market, nor are we. That would cause a pocket.
There is sort of a sense of like being at the carnival and playing whack-a-mole, right? Like you just don't know where it's going to pop up, and you're just trying your best to hit it and beat your opponent. But at the same time,
hopefully you're ambidextrous.
I think they only give you one hammer at a time, unless you steal the kids next to you. But it's really true that there's so much that, as you said, the chances of what you described as reinflation might be lower, but they're not off the table 100%. So there is kind of that risk there. So if you had to do a quick takeaway, Leslie, for fixed income investors, as we're starting the new year, we're here and sitting in January 2024. What is the takeaway here for investors today as they look down the road 6 to 12 months here?
Well, first of all, you definitely want to take a part of the cash. You want to lock in long. You want that interest rate risk, right? You do. You want to take that yield. You want to lock in. You want to take that interest rate risk. But again, as I mentioned before, it doesn't mean we're going to have a straight line lower to 3.5%. There's going to be volatility, right? But just because there's volatility in the short term doesn't mean at the end of the year you're not going to end up lower, right? And particularly now where we are in the cycle, and particularly because we think the Fed will ease in 24, more than likely at around the third quarter, right? So, but with that said, too, while you put some of that in your lockup, you also don't want to chase markets. So you really want to pay attention also this year to your entry points, because in the short term you might have a 4.5%, right? So don't chase markets. Pick your entry point in terms of where it really benefits yourself and your clients, and stay in that higher quality. There's no reason to go down in credit and chase these yields right now. And if you want to do the yield play, do it on your alternative sides with things like private credit. Don't do it with necessarily the public credit or the high yield market right now, given where spreads are. So what we want to do is to say take in yields, get that price appreciation. You want to have around that 5-year area of the yield curve. We prefer a barbell. And don't get too exhausted by looking at the intraday volatility that you're going to see, because again, you're going to see it. But no, down the line, 6-7 months down the line, you'll be in the money. And
I was going to say, the great thing is you mentioned the word volatility. I think people should not be so scared of that word, because it is going to be a potentially volatile year. Don't just be so reactive. Make sure, of course, that you're working with your financial advisor to make sure you have a long-term plan or a 3 to 5 year horizon. But volatility is here. It will continue.
Absolutely.
Don't get too scared of it. There are opportunities there.
There's no question, particularly when you look at things like the supply that we're going to have, that they're still doing quantitative tightening. You're going to have these pockets of interest rates going up.
Right.
That doesn't mean that's a trend for the next year or two. You just have to understand you're going to have these pockets, but they're not going to be long term, and the market will digest it.
Absolutely. Well, Leslie, good to have you here. Happy New Year.
Happy New Year.
Looking forward to many more conversation in 2024 with you. So good to see you. Thanks,
You too.
Leslie.
Thanks so
and
much.
don't forget, everybody, before I get to all the disclaimers here, make sure you're following Leslie on our website, ubs.com/views, which is our insights page, which leads you to all the CIO content, including Leslie's Fixed Income Strategist. It's a monthly publication, so make sure you're checking that out. And don't forget, make sure you're following us on social media as well. We're on all the channels, including Instagram. You can check out our dedicated @UBS Trending Instagram channel for all kinds of really cool content coming out of the studio. Plus, as we say every time, make sure you are having conversations with your financial advisor to make sure you're making the right decisions for your investment horizons. Until next time, I'm Anthony Pastore. Have a great day, UBS, and remember to keep your eyes on what's trending. Thanks, everybody.